Hello, everybody, and welcome to the Tortoise channel. Happy to have you join us. Today, we will be covering 5 books that actually had a significant impact on my life as an investor. They really were big game changers, and hopefully, the same will happen to you. Okay, so if you still are at the early stages of your investing journey, and if you still have a lot of lead learning to go through, then stop whatever it is that you are doing and please make sure you note down these 5 books because they are really game changers if you understand the essence of each of them. Okay, so for each of these books, I have a Word document with long summaries, but I also made sure that I created a document that actually makes a brief that actually compresses the main findings into a couple of sentences. And the goal is to really drive home the most important aspects of each of these books. Okay, so like I said, guys, if you are watching this for the first time, maybe you don't know me, but I started my career. I started my journey in investing as a trader, and I made a ton of mistakes, which caused me to blow up a 10K account. I talk about that in one of my previous videos, so feel free to go back to it. And I make those mistakes because number one, I didn't have a framework. Number two, I I I still have had a lot of learning to go through it, but like many people, I just tried to find shortcuts, and so I was just playing around, speculating, of course, and no framework, no idea what I was doing, and I end up losing money. But then when I became profitable was when I actually started investing in my education, which is something that today I do with my clients. First, we have to lay the right foundations, and only then can we start thinking about compounding money sustainably over time. And and this is exactly what I want to get across. All right, education is essential, and the easiest and also cheapest way to actually start your education journey is by getting your hands on great books. So here are 5 books that actually made a big difference for me. Okay, let's jump right into them. So I shared these whenever people ask me, "Hey, Ed, can you just are there any books that you recommend on investing in fundamental analysis?" The question is absolutely yes. I love reading. I read a lot, and your learning never stops, no matter how many books you read and how great and how successful you are as an investor. You will continue to be a learning machine. Okay, and that's awesome, right? It's just awesome because otherwise I would feel stupid, and I don't really like that. So the first book that I would recommend is Phil Town. Many people only recommend they so many people, certainly in the investment space, always recommend The Intelligent Investor by Benjamin Graham, and I understand where they're coming from. The problem is that that book is very complex for new beginners, if you ask me. And so unless you come from a financial background, you will find that book quite, number one, it's quite dense because the book was written in 1950, or yeah, in the 50s. So the author Ben Graham takes like 3 pages to say to say something that he could easily say in 1 or 2 sentences. And number two, many of the concepts discussed are, well, there's a lot of financial jargon, okay, which makes it very overwhelming for people who don't come from that background. So my recommendation is start with this book, Real One Number One. Rule One Investing by Phil Town. It's a great book. If you know me, if you have following the channel, you know that, for example, many of my investment methods actually I learned them from by attending Phil Town's 3-day virtual workshop. It was very insightful, and I just incorporated many of those teachings into my core strategy. But the core idea around this book is invest like a business owner. Only when you understand the business can you actually buy it with a margin of safety. Why does that happen? Because if you don't understand the business, how can you put a value in it? Getting to the margin of safety, guys, is the easiest way. because it can be 30%, it can be 40% of the value. That's easy. What is not, what's a little bit more complex is to put a value on the company. And for that, you have to understand the business. And so Phil Town goes to great lengths to distill Warren Buffett style investing into a practical, repeatable framework. And another another thing that I love about the book is that many of the metrics that he points out are metrics that really can be used across different businesses in industries as well. We are looking at things like earnings per share growth rates, margins, book value per share growth rate, free cash flow growth rate, debts, right, the levels of debt, and also returns on invested capital. So it tells you to focus on a few handful of companies, but most importantly, those companies should be consistent over time. And if that is the case, in all likelihood, you will be in the presence of a moat. In other words, a company with great competitive advantage. Okay? So he also emphasizes patience, discipline, and saying no far more often they say than saying yes. So the key themes are long-term ownership over trading, yeah, high quality companies with durable competitive advantages, margin of safety as non-negotiable, simplicity over complexity. I always pound the table on margin of safety, and you guys know that. And I think the person who actually laid that actually ingrained that in my brain was Phil Town, because he told me, I mean, he, of course, when I say he, I mean his books and his webinar. They told me that no matter how great the company is, every now and then there will be shadows over that will so well clouds, right, clouds that will appear or that will hover over the business, and that is the time when you should invest, right? Then the next one is and by the way, so the filter the rule number one marginal in the rule number one investing, the core method for valuing a business that is discussed in this book is the margin safety price. And as you can see, I use that in my sheets. Look at that. This is the margin of safety calculation, right? So that's one of his methods. And he discussed that firstly in his book, rule number one. Okay. And the other one, book number two, which I also recommend. In fact, I actually prefer book number two, Payback Time, to the margin of safety. But this one was really the game changer for me because I think it laid the foundation. Yeah. And then from then onwards, I was able to, okay, so this is how I should behave. This is how I should think. Okay. So that one is the most important, but I prefer the Payback Time book more. I prefer this better. Not least because it also touches upon the margin of safety calculation price. All right. So let's continue. Payback Time. Core idea, your capital should pay you back through owner earnings over time. Price matters just as much as quality. This book builds on rule number one by going deeper into valuation and capital allocation. Phil Town explains how to think about investments in terms of payback periods, right? Free cash flows and opportunity cost. The focus is on avoiding permanent loss of capital by refusing to overpay, even for great businesses. What I love about this method is its simplicity. Let me explain. I can do this so easily right now because the method is really that simple. Let me just give you, you can go back to my previous videos on valuation and you can see that I will cover payback time there. But for example, let's use, I'm right here, Meta is on my watch list. It's right here, as you can see. So let's do the payback time calculation for Meta and you will see how simple this actually is. But for example, let's say that the current market cap is this one. The company has this number of outstanding shares. And let's get rid of that. I don't want you to get confused because it's really that simple. Let's get rid of that. This is what matters. I just want you to focus on the number of outstanding shares. And let's get rid of that as well to avoid any confusions. These are the only things that you need to calculate this method. to just do this method. So number of outstanding shares, last 12 months free cash flow. Let's say it's 52 billion. Then you need get rid of this. Then you need to so you have number of outstanding shares, last 12 months free cash flow. What you are trying to do with the payback time is you wanna think as a business owner. And so if I bought Meta today as a business, if I bought the whole company today, how long will it take me to get my money out of the business, either from earnings or free cash flows? Okay, that's the question you are asking. And ideally, you want to get your money out of the business in no more than 8 years. Why? Because the average payback time for an S&P 500 company is 16. In fact, the average PE, if you zoom out on the chart, you can see that the average PE of the S&P is about 16 times earnings. So that means that's the average payback time for an S&P for an S&P 500 company. But because we want a 50% margin of safety, we want to get paid in 8 years. Okay. And so if I assume that the free cash flows, look at that, free cash flows in year zero are 52. If I grow these free cash flows at my assumption, or my 15% compounded annual growth rate assumption, yeah, then I know that after 80 years, this is how much I will have, 160 billion. And then you just do the cumulative free cash flows, where you sum all the free cash flows from year one to year eight. And that gives you this much, right? So it gives you this number that you have right here, 822 billion, 822 billion. And then the only thing that you have to do is you divide this number by the number of outstanding shares, and you get the free cash flow per share. You get the free cash flow 8-year payback time price, and that is 314. What does that mean? It means that if you want to buy Meta and recoup your investment in 8 years from free cash flows, this is the maximum you can pay. And the lower, the better. Okay. And now you can just do the same thing for earnings, and you will get 334. This is because Meta, as you guys know, has been investing a lot in AI, which of course makes that which explains the difference between net income and free cash flows. Okay, but ideally you want to see them closely. You want to see them aligned. So that's it. That's what payback time entails. It's very simple, right? It's simple, but it's very, very powerful because it has that 50% margin of safety built in. So if you can pay that for a great company, that is awesome, guys. That will allow you to make a lot of money, provided the company has a moat. Okay, so valuation discipline, thinking in cash flows, not stories, avoiding emotional and narrative driven investing, capital preservation first, returns second. Okay, and then we have the little book that still beats the market. Oh my God, how I love this book. It's so simple. And again, the principles discussed are timeless, just as timeless as they are powerful. So combine business quality with cheap valuation systematically. He introduces the famous formula called magic formula, which ranks companies based on high returns on capital and low valuation. And so what he found out is that if when you buy companies that have the best combination of high returns on capital and low valuation, chances are over time you will greatly outperform the market. So while the formula itself is mechanical, the deeper lesson is timeless, right? Great businesses bought at fair or cheap prices. I don't want them at fair, I want them at cheap, which is exactly what distinguishes me from quality investors, outperform over time. The book reinforces the importance of patience and sticking with the process through inevitable periods of underperformance. So, for example, if I go here, for example, to my calculator, to my intrinsic, to my valuation template right here, and I show you here. Let's see, for example, to give you examples as we go through this. For example, look at that PayPal. You can see that, let me do this. Look at that. Look at the earnings yield. So he focuses on two things, right? He focuses on returns on capital and earnings yield. The higher the returns on capital, the better. That is a sign of a quality company. And the higher the earnings yield, the better, because it means the cheaper the business is trading at. Okay, you want that best combination. And look at the earnings yield for PayPal according to Joe Greenblatt's formula. You do the operating income divided by the enterprise value, because the enterprise value accounts for that. Okay, so if you bought the whole company today, you will be buying both the equity and also the debt. And so it's more realistic to use this formula if you are thinking as a business owner. And you can see that the earnings yield is almost 10%, guys. What does that mean? It means that we are getting a lot of value, right? It means that we are getting a lot of value relative to how much we are paying. We're getting a lot of value in earnings relative to how much we are paying for the stock. That is great. And what's also great is that, okay, this is a sign of cheapness, but what about returns on capital? And you can see that returns on capital in the case of PayPal are also are also good, right? In fact, you can see, let me show you right here, you can see that, let's go to statistics. Bear with me 1 second. Let me just narrow this down. If I go here to financials and the ratios, you can see that the returns on invested capital have actually been improving since 2022. Okay, they were low, they are now improving. And the same thing goes for the return on assets, for the return on equity, as you can see right here. Okay, and also ROS, the return on capital employed. So you have the best combination of a good business and cheapness. Okay, cool. I hope I love that book also because it's a very short read, and the key themes are this: quality plus value beats either alone. So that's why I don't just focus on value. I also want to buy quality. This is very important. Process driven investing, long term statistical hedge, ignoring short term noise. Book number 4, Common Stocks and Uncommon Profits, Phil Fisher. Many people actually, how can I say, many people attribute the idea of quality investing to Phil Schipper. They say he was actually one of the I can't remember the name right now in English. Sorry about that. But he was one of the guys that actually started this process of quality investing, because he really delves deeper into qualitative aspects of a business, right? Stuff like, for example, management teams, suppliers, employees. Are the people are the people happy? Stuff like that. Okay. So the core idea is exceptional long-term returns come from owning outstanding businesses for a very long time. This is the core of the book. Okay, and I love that because Phil Fisher had no problem. He had no problem concentrating his portfolio. In fact, at one point he was owning about 10 companies, something like that. So he ran a concentrated portfolio of high conviction names, and then he owned them for the very long term. And one of those companies which has become a compounding machine in his portfolio at the time was Motorola. He never sold the stock, even though the stock appeared expensive at times because it was growing very well. Okay, he focuses on qualitative analysis, management quality, company culture, innovation, and long-term potential. He popularized the idea of concentrating in your best ideas and holding them through market cycles. So this book strongly shapes the business owner mindset and complements Graham's style valuation with deep business understanding. And this is what Warren Buffett loves as well. Warren Buffett many times has said that his investing style is a mix of Phil Fisher and Graham. Very important. He says more specifically that he's 90% Benjamin Graham, and 10% Phil Fisher. You can see that. And Phil Fisher is the guy who mentioned that the market is full of people who know the price of everything but the value of nothing. Huh? Let that sink in. Very important. I love that quote. Awesome. And of course, last but not least, how could I rule this out? We have the intelligent investor. But my suggestion again is read these four books first before you read the intelligent investor. The intelligent investor, the core idea is protect yourself from permanent loss through discipline and a margin of safety. So whenever you guys give me those shiny objects for me to analyze, I always cringe. Like all those companies that have no track record, no consistency in earnings, I always cringe because as a quality driven investor, I want that combination of quality and value, but you also want to stay away, right, to shy away from shiny objects that everybody else knows they are great already. So what's your edge there? You don't have any edge. The biggest edge comes from adopting a contrarian approach, from selling when people want to buy, and from buying when people want to sell. And doing that consistently over time. The most important thing that Ben Graham discusses is the importance of the margin of safety. Put a value on a company, and then you have a margin of safety. Number two, you are not buying stocks, you are buying businesses. This mindset has influenced the style of hundreds of successful investors that appeared long after Ben Graham, Warren Buffett included. Okay, so it's very important to understand that. Let me go back here. Okay, let's see. Often called the Bible of value investing, Ben Graham's work teaches investors how to think rationally, control emotions, and distinguish between investing and speculation. While some examples are dated, the principles are eternal, namely margin of safety, patience, and emotional control. Mr. Market, which is the analogy that he uses, remains one of the most powerful metaphors in investing. Why does it use Mr. Market? Because he says that the market is in the short term the market is a voting machine. In the long term, the market is a weighing machine. And so, Mr. Market, we as long-term quality investors will take advantage of volatility in the market. So when the market is in an euphoric state, we will be selling. When the market is in a fearful state, we will be buying. So Mr. Market is here to serve us. Key themes. Here we go. Investor psychology, long-term patient, risk management over return maximization. What is the shared lesson across all 5 books, if you haven't noticed it already? Long-term time horizon. Okay. All these investors that you see right here, Phil Town, Joe Greenblatt, Phil Fisher, have all been extremely successful investors, and they all share these principles. Long-term time horizon, wealth is built through compounding, not predictions. Quality first, strong businesses with durable advantages outperform over time. I have to say that Benjamin Graham, unlike Warren Buffett, didn't really emphasize quality. This is important, okay? So Ben Graham, his approach was he would emphasize value above all else. He didn't care about quality companies because his goal was to buy companies that were heavily depressed, what he called cigar butts, like those cigar butts that only had one puff left. This is actually what Buffett says, cigar butts. And then once they reach the real value, he would just dump them. Okay, and that's it. So quality was not important for him. What was important was to get businesses very, very cheap. Buffett doesn't do that. Buffett then was doing that in the early stages of his career. in the first years actually, but then he pivoted to a quality investment style, also because he was influenced by his partner Charlie Munger, and then he started focusing on buying high quality companies at a reasonable price. Okay, so it's important to understand that quality is not something that Graham would really uphold. Business owner mindset: buy businesses, not tickers. Definitely something that is common across all of them. And then, of course, margin of safety. Price matters. Even the best company is a bad investment if you end up overpaying. Okay. So together, these books form a coherent framework for calm, rational, and repeatable long-term investing, the foundation of the like a tortoise philosophy. Slowly and steady wins the race. Okay. So, guys, let me know if in the comments below if you find this video educational. Maybe you have already read these books. Maybe you may have other suggestions. In which case I want to learn from them. So make sure that you leave the comments below. And again, share this video, please, with anybody that can benefit. And let's continue to create value for our subscribers, viewers, and let's continue on our journey together. Thank you so much for the ongoing support, everyone.